Strait of Hormuz, is that a waterway or has it become the new Bermuda Triangle? You know, over the last 120 days, every eye across the globe has been focused on one waterway called the Strait of Hormuz. And the reason why I refer to it as the Bermuda Triangle is that it seems like every day is a new day of events taking place that really kind of stranglehold or directly affect global energy markets, cargoes, political, geopolitical risk, etc. I call it the Bermuda Triangle because for me, it just baffles the mind that the United States has entered into a military conflict and someone in that entire decision making never thought, what happens if we don't have the ability to continue to use the Strait of Hormuz for moving product in and out of that waterway? It's a Bermuda Triangle because let me tell you what's taking place in my humble view. All these vessels that are sitting inside the Strait of Hormuz that were trapped, they exit the door crossing by Iran closed, or it became very precarious. So vessels, 20,000 mariners are trapped on the inside side of the Strait of Hormuz, outbound directionally trying to go. New ships don't want to come in. They don't want to take the risk. They can't get the insurance. They're saying to themselves, do I want my vessel tied up for months at a time in a military war or conflict? The answer is no, or definitely not. So I want to think about you and I as consumers around the globe and what we're dealing with today. In the 1990s, if a mosquito passed gas in the Middle East, oil went up $25 a barrel. Okay? It was so touchy in terms of geopolitical risk and sensitivity, oil prices would skyrocket if anything happened in the Middle East that even remotely looked like disruption or uncertainty. Here we've had this week with the MOU being broken. There is no more stand down. There is no more talks. President Trump said, it's over. You don't keep your word. You're bad guys. And we've had 90 different areas or military activity in the last 48 hours in Iran by the U.S. military. So now we're dealing with is the Bermuda Triangle. Today it's open, tomorrow it's not. Today we have 500 vessels, we get 50 through, everything's okay. Tomorrow we don't have 500 vessels, we have 450, but now they're trapped or they're moving at 10 or 12% a month. The Bermuda Triangle is you never know what's going to happen once you enter it. You don't know if you're going to get through a safe passage or you'll be that ship that disappears. You don't know day to day what's happening in one of the most heavily trafficked straits in the entire globe that is economically so sensitive it's affecting almost every oil, fossil fuel consuming country on the planet. Let me add something else to it. When you have an event like this and you have this Bermuda Triangle effect, facts start evolving. What kind of facts are evolving? Well, number one, I think everyone's very clear, we did not have any kind of depth to our alternative energy sources. Nothing else could replace the crude oil that was disrupted in supply that came to the Strait of Hormuz. That's number one. Number two, this particular event rattled the cage of every single consumer of oil and gas that doesn't have oil and gas production in their own country because they realized, wait a minute, I don't really have enough oil and gas in supply. I had enough for 6, 8, 10 weeks. This is going on 4 months. So the attention now is, how do I prevent, as an inbound consumer of oil and gas from the Middle East or any other supplier around the globe, how do I protect against this so-called black swan event of global disruption in crude oil supply? How to prevent it from affecting me again? Well, I better go get some hydrogen or nuclear or wind or solar, or I better build a ton of storage very quickly so when I finally can buy enough oil, I'm going to build up enough for 3, 4, 12 months at a time. So if there's a disruption, it never disrupts my economy again. Well, if everyone does that, what kind of demand will there be for oil when everybody says, I need oil for today's consumption? I need excess oil so I can put 100 or 200,000 barrels a day over the next 6 months to a year to have at least 3, 4, 6 months worth of excess supply on hand. You multiply that times all the different consumers out there, there's a huge demand for crude oil over the next 24 to 36 months. There's another factor that we've learned because of this political event and because of this war in Iran and the Strait of Hormuz, and that is what? The United States needs that strait open more than they need it closed. because the president's tried very carefully to play his poker hand, but he hadn't played the poker hand too well. One day it was open up the effing strait. The next day is we're going to do a complete shutdown of the straits and we control it. Then we have an MOU, which really is a non-binding agreement. No one ever adhered to it in the first place, and it's now fallen apart in less than 2 weeks. So that means the very critical part that was required to come to some kind of terms was no nuclear weapons and open up the strait. Both the Iranians have not given permission, nor they have acquiesced or given up to President Trump in his desired terms. So today we have another factor that's come out, and that is, could China have just put themselves in position intentionally the last 10 or 20 years to be the key swing player on the demand side? Now, we know that Saudi and OPEC have been the king swing players when it comes to supply. They want prices higher, they cut back supply. They want prices lower, they oversupply. We've watched for the last 25 to 40 years. But today, no one ever figured that there could be a demand swing player, which China has become. Now, I talk about this because it's very real and it's growing. If China can continue what they've been doing the last 45 days, which is not buying 6 million to 7 million barrels a day in the open market, wherever it comes from, and they pull it out of their reserves, which is about 1.4 billion barrels of reserves, well, guess what? We have an oversupply of 6 to 7 million barrels a day. It's worse than demand destruction because it's intentional demand destruction. So China can sit there and play the game of, let's not buy 6 or 7 million barrels. Let's drive the price of oil down to low 70s, low 60s, could even go to the $50 range. And then all of a sudden, China's going to say, now that we have capitulation, we have other countries find out that break-even's higher, they can't drill new projects, it's killing the future capital expenditures. Even if for 90, 180 days, half a year, it plays into China's hands. How does it play into their hands? Well, while they're using their current reserves out of storage to help manipulate the demand side so it crushes oil prices to a lower regime, what do you think they're going to do? They're going to go buy under contract enough oil to fill right back up those same reserves they've had in storage, right back up to the brim with $45, $50, $55 oil. And then what are they going to do at that point? They're going to simply play the market. Is it better for us to buy out of our storage, or is it better for us to buy out of the open market? Having a swing demand player has never been seen in my career. That's 41 years. It now adds a new element of how long could China be a swing player? Well, if you do the math on it, right, they consume about 16 to 17 million barrels a day. 11.5 to 11.7 million barrels a day. They produce 4.5 million barrels. So that means what? They've got to find that other 6 or 7 million barrels outside of China. Well, if you do the math on how long that takes to run it out, they could effectively shut off all consumption from internally produced oil and gas and all external importation of oil, and they could last about 180 days off the reserves they have of 1.4 to 1.5 billion barrels of oil. I just want you to think about the Bermuda Triangle. That Strait of Hormuz, the factor of China being a demand player, the factor of what's going on with the MOU that doesn't exist, the factor of replacement barrels taking place logistically and geographically in different locations. There's never been a more widely scrambled sourcing and usage and consumption and directional flow of oil that I've seen in my 4-decade career. So as I look at the new elements of what China can do, what Iran is doing, what Saudi's doing with new pipelines, what other producers around the world are doing, what the UAE has done by dropping out of OPEC, we don't know where the supply and demand curve is going to be today. I don't even think we know where it's going to be in 12 to 24 months. So I would say the oil and gas industry and the flow of international oil has entered the era of the Bermuda Triangle. It's a factor of unknown facts. It's an element of unknown forecasting. It's a surprise every day. And I think we're all going to have to navigate and figure out what that looks like in true, real terms. I don't think anyone really knows today. I think everyone's making great guesses. If I had to give my personal input, okay, I believe you're going to see softer oil prices over the next 4, 5, 6 months because of what China's doing. I think once they stop manipulating the demand side of the curve as a demand swing player, there's going to be a massive void in capital, as it has been the last 10 years, and there's going to be significant potential problematic issues for major producers like the United States who have recoiled because of lower oil prices, slow down their drilling, slow down their fracking, let the production get stale, stop the infrastructure spending, and also now we're back to a true mark-to-market supply and demand curve, which could mean a much higher demand for a stale or static quo supply. That means much higher oil prices to maybe the $90 to $100 barrel, not because of a war, but because of pure supply and demand fundamentals. That's my opinion. Maybe I'm right, maybe I'm wrong. We'll find out.